Every February, people celebrate getting their own money back. I did it too. I bragged about it. Until I found out what was actually happening.
Every year for a long time, my tax refund came in, and I treated it like a bonus, a down payment on something, a vacation. Something new I'd been putting off. I bragged about it. I'd tell people I got $3,000 back this year like the government had just done me a favor, like I'd won something. I never once stopped to ask where that money actually came from. Nobody explained it to me. So let me explain it to you. A while back, I was watching one of those finance channels. The kind that gets into how people who work hard still end up broke. And the guy on there said something about tax refunds that stuck with me. He said a refund isn't a gift. It's your own money coming back to you late with no interest. I didn't fully believe that. It sounded too simple. So the next time I sat down to do my taxes, I wrote one question at the top of my notebook. Before we talked deductions, before we talked credits, I stopped my accountant and asked it first. Is my tax refund really just my own money coming back to me? He didn't even pause. Yes. That was it. One word. And I sat there for a second doing the math on how many people I'd bragged to about that win. Here's what's actually happening. Every paycheck, the government takes out a little more than you owe, not because they need to because the W-4 you filled out on day one of a job was set to withhold more than your actual tax bill. And most people never touch it again. So why does the system work this way in the first place? It's worth understanding because it's not an accident. The government would rather over-withhold than under-withhold, because underpaying comes with a penalty. So the default settings on that form are built with a cushion, a little extra taken out just in case. It's a system designed to protect the government from ever being owed money, not to protect you from ever overpaying it. And your employer isn't going to fix that for you. It's not their job. They withhold exactly what the form you signed tells them to, and then they never think about it again. Nobody checks in a year later to ask if your situation changed. That form just keeps running on autopilot until you go back and touch it yourself, which is exactly why so many people never do. So that $3,000 refund in February wasn't found money. It was $250 a month, quietly leaving your paycheck all year, sitting outside your account, earning you nothing, and getting handed back to you 12 months later like a surprise. Now, here's where it actually gets expensive, and I want to walk through this slowly because the number alone doesn't do it justice. That $250 taken out in January isn't just $250. It's $250 that could have been invested in January, which means it had almost 10 years to grow before this year's version of that money would even get a full 10 years. February's $250 lost a month of that growth. March's lost 2 months. By December, that year's last withheld dollar barely had any time to work at all. You're not just losing $250 12 times. You're losing 12 different head starts stacked on top of each other every single year you don't touch the form. Add that up over 10 years of doing this, and $250 a month invested at an average market return turns into somewhere between $36,000 and $45,000. That's not a refund. That's a down payment on a house. That's a real chunk of a college fund. That's wealth building quietly in the background. Money that instead sat outside my account earning exactly zero, waiting for me to spend it the moment I got it back. Here's a way to feel it, instead of just calculate it. If a friend asked to borrow $3,000, told you they wouldn't pay a dime of interest, and said they'd give it back in 14 months, would you say yes? Most people wouldn't. I wouldn't. But that's exactly what I've been doing every single year, just with the government instead of a friend. Now, I want to be fair here because this isn't as one-sided as it sounds. Some people want the big refund on purpose. If your income is unpredictable, over-withholding is a way to avoid an April tax bill you can't cover. some people genuinely use it as forced savings, because if that $250 showed up in their checking account every month, it would just get spent. For them, a refund isn't a mistake. It's a system that actually works, because it accounts for how they really behave with money. I'm not most people. I know myself well enough to know I'd rather control that money monthly than get surprised by it once a year. So once my accountant confirmed it, I went home and adjusted my W-4. Not to cut it so close that I'd owe a big bill in April, just close enough to even that neither one of us was carrying the other's money for long. Then I set up an automatic transfer. The $250 that used to disappear into withholding now goes straight into a high-yield savings account the same day I get paid, before I can talk myself into needing something with it. These days at tax time, I owe maybe $100 or they owe me $100. Either way, I'm close to even. And for the first time, being close to even feels like winning, not losing out on a big check. Here's the hidden rule underneath all of it. A refund isn't a bonus. It's a correction. And the size of that correction tells you how much interest-free credit you handed out over the past 12 months, whether you meant to or not. I gave away an interest-free loan for years without ever realizing I was making one. I wouldn't do that for a friend. I'm not doing it for the government either. I spent years celebrating getting my own money back. I don't celebrate refunds anymore. I celebrate paychecks, because that's the day I get to decide where my money starts working, instead of waiting a year for someone else to give it back.